Hey, good morning, everyone. It is 9:45 on Wednesday morning, the 11th, and this is our regular market chat. I'm hoping to be about 10 minutes or so on this video, and what I want to do is walk through what the charts look like and walk through a little bit of trading strategy before the report tomorrow. Obviously, anytime you have a big report like the quarterly stocks and the January 12th report, the volatility that can come out of it will be significant, and you should plan on that. And from there you start trading. So this technical picture leans bearish. That can change tomorrow if price action warrants it, or it can be confirmed. And it's really anybody's guess as to what can happen. So this is new crop soybeans. Again, we like being short beans for a lot of reasons. Most importantly, is the size of the crop coming from Brazil. I know Argentina is dry, but then secondarily is following up on the video we sent out yesterday with our balance sheet overview, and just understanding that big picture, from a 50,000 foot view on 2023's farm marketing. Our view is that there is significant risk that our balance sheets are replenished in supply and we have burdensome supply issues. And to us, that means that there is a significant risk of lower prices. So our bias and our plan is to hedge first and then battle uptrends using options and other weapons, because I would much rather have you guys upset at me that prices are roaring higher than, hey, we're down here at $12 beans and we don't have any sales on. In times past, that would be a risk we're willing to take. But I think this year, with the outlook that we have, I don't think that's prudent. So our advice is be hedged. And if we break up out of here, we'll revisit it and we'll rethink what we're doing, and we'll make adjustments. So hedge first, adjust later. This picture does not lean bullish to us. We think that downside is significant. How significant? Well, let me put some Fibonacci targets up here for you. Off of this decay on new crop soybeans, we are talking a move down to 1140, potentially all the way down to 1080. And if those forecasts that we came out with yesterday on balance sheets are anywhere close to accurate, you could be looking significantly lower, all the way down below $10, down into eights. And it makes sense. If you have a balance sheet that is at 700 million bushels, you're not going to be at 10 or 11 or 12. You're going to be down in this area down here. So these are all legitimate targets. And I know that sounds wild. I know that sounds nuts. But if you've been with us over the last several years, you'll know that in 2020, in June, July, and August, we were talking about upward projections of $7.50 and $8 corn, which sounded absolutely insane when we were trading at $3. Okay, so just because you don't want it to happen doesn't mean it can't, and our job is to have you prepared for it and positioned for it before it happens here. So that means we have to take a risk of being short below this area because we have objective spots to recognize where we're wrong. Okay, and just on this chart you can see 4 of them. Here's 1, 1404, 2, 1427, 3, back here at 1435, and 4, 1448. So we've got 4 objective areas where the soybean market, if it trades above it, will tell us that this analysis is wrong and we need to be looking for higher prices. Okay, and I'm much more willing to take that risk than the other, because just down to the lows is $1.80 a bushel, while to the top resistance point is only 50 cents. So we're risking 50 to make $1.80 on the short side. That is risk management. That is trading. That is a no-brainer for you to take. Okay, so how are we positioned here? I like just being sold cash, and we'll put futures on or make an adjustment up here in accounts if we get up into this area. So I think for now you're just sold cash, and you just don't worry about soybeans. Old crop beans, absolutely no difference. The targets are even bigger to the downside on old crop. you're talking significantly lower. I don't think March can get that low, but I do think March can get down to this $12 area in the next 45, 60 days if that Brazilian crop really confirms. And again, like November, you've got a potential for a $2 or $3 move against a risk of basically 40 cents, 50 cents, or all the way up to 15.72. The risk reward favors the downside here, not the upside. So that is where we want to be positioned. Specifically, if you are short March futures in a speculative position, what we want to do is buy $15 calls to hedge it for tomorrow, because while we are bearish, and yes, we think that that's the right view, we are very respectful of the market's ability to rally, even short term. So we want to be defensive to that and protect capital, especially in a hedge position. So I would rather have $15 calls in short futures than any other position in this market. And if you're got bushels in a bin, I would either sell them or put a future stop right down here at 1460 and not let it get below that, because I think 1460 breaks and you can kiss beans goodbye. All right, let's look at new crop corn. No change to this analysis here. We've been working lower. We've been wanting to be short new crop corn. I think that's got to stay in place. And currently, we have rolled our short futures in this market back to long puts in March. And the reason we did that is because of the inverse, and because if our analysis is right and demand gets weaker, or if the USDA raises yields or finds more bushels, then March is going to fall harder and faster than December will, and those puts will pay out well with an increase in volatility as well. In spec positions, where we are currently at is we are long 670 March puts, and we are short 690 March calls. What we want to do in that position, and this is a free position for us, so because that position is self-financed and paid for at this point. So what we want to do in order to respect the market's ability to rally and reward it for its move to the downside, what we want to do is buy in the 690 calls that we have. We sold those for I think 13. What we want to do is buy them in for they're currently trading about 7 or 6. We want to buy them in, and I want to buy 2 to 1. So what I want to do is I want to get into a long 690 call against a long 670 put into that report. If prices explode lower, great. The 670 put will be 7 cents worse off. That's fine. If we rally and blow up higher, that 690 call will defend the premium that we have in the 680 in the 670 put. Okay, so that's what we want to do there is just manage capital. So I'm not saying buy corn. I'm not saying get long. I'm not saying take a big speculative risk. I'm saying, hey, don't be stupid. The market can rally even short term for no reason. And you have to recognize and respect the fact that that can happen, even though our analysis is super bearish and it can go lower. So that's our analysis on corn. Now wheat is the harder one. It's a very difficult read for us here because we are getting conflicting signals. So first of all, big picture, we've broken down below the shelf, which is a sell signal. That is a sell all day long, and there's no reason in this recent trend here down that we would think that is ending. There's absolutely no price evidence that wheat should turn higher. In fact, we think it probably should turn lower, and that we have a significant risk of more downside. I still like the move down to 750, possibly even lower, depending on what the report does. Now, weighing against that are a couple things. First of all, you can see this indicator here and this one down here. What you're looking at are bullish divergences. So this low here corresponds with this low on the oscillators, but this low is higher than the prior low. So you have lower price action, with higher oscillators, which means that the momentum or the selling interest may be exhausting here. And we also are getting ready to get a 13, which is typically an area at which to look for a bottom. So there is a risk here that wheat is running out of steam to the downside and may be ready for a rally. We don't think that's a long-term rally, but we can't rule out the risk of a bounce. So I wouldn't sell more wheat here. I wouldn't do that. What I would do is be more willing to defend hedges if you have them on. I would defend a hedge up to the 850 area on March Kansas City wheat, and by putting in either a future stop or buying a 850 call for 20 cents, which is currently the 850 call is trading for 17. So you can buy that call, or you can just put a future stop in here to exit short futures at this level just in case it does explode. And the only reason for that are these divergences down here and just the risk of a volatility event coming out of the report tomorrow. You cannot rule out that could happen. And you're in profitable positions and hedges here, being short Kansas City wheat. So you just, again, don't want to be silly there. It's difficult to say lift your hedges because we are in a position where this thing really could accelerate lower if $8 breaks. And the acres are there if the weather turns to normal, and if corn breaks and that piece of the analysis comes true, then wheat is not going to go higher. It's got to go lower. So I'm really hesitant to say, hey, just lift your hedge and we'll give it some time. I would much rather just say, hey, put a call on it and don't worry about it, or make it take you out higher, because I don't think you'll be fast enough if it's a bearish report to get sold again if we break lower. I hope I'm being clear on that. I'm not bullish anything, but we're respectful of the market's ability to rally. And we don't want to be naive to the fact that the USDA can say what it wants and none of us have control over that. So I would buy an 850 call, or I would put a futures buy stop at the 850 level here to preserve capital on hedges that I have on short futures, or spec positions that I had on. I would defend that 850 level, because look what would happen here. If we reverse from this level, you would confirm a bullish divergence. You would trade back up above these two swing lows, and you would trade back up solidly inside of this trading range. That would lend a lot of support to some short covering, and it could get more exuberant than you think it should. On the flip side, if it does break lower and we take out this low right here and take out $8, then goodness gracious, this thing could really accelerate to the downside. So I want to stay hedged, but I want to be careful with it as well. I hope I'm clear on that. We'll send out some text recs as well as we get through the day here and start to reposition things. Again, I would rather us be shorter the market and have to defend against rallies given the fundamental outlook as we see it. I think that's the only prudent position to recommend farmers be in going into this report. Remember, there is significant risk in futures and options trading, and you should only do so in light of your own financial condition. If you have questions or want help creating positions that suit your farm and work through your and meet your risk tolerance, please call us. We're happy to help you design those. I hope you have a great day. We will be back out with you tomorrow after the report sometime. I don't know if that'll be before market close or if we'll wait till after. And then we'll probably do another one on Friday just to see how the market is digesting whatever it is that the USDA throws at us. Happy trading. Stay safe. We'll talk to you guys later.